All right, my fellow financial analysts, we've covered a lot of ground, a lot of material. I have saved this ratio, this return ratio, for last on our list of returns. The return on invested capital. This is a ratio that was developed recently, just in the last 20 years or so. This has become a very popular ratio to look at, a popular return measure to look at. I remember that when I was in graduate school taking finance courses, sitting in class one day and thinking about return on equity and wondering if return on equity was actually an adequate measure of how well a company's doing, primarily because, in my mind, net income is not the cash flow number that we should be looking at. We really should be looking at what the company generates, more of a measure of cash flow as opposed to net income, which is more of an accounting item. And so I'm thinking we should put some form of cash flow in the numerator over some form of investment in the denominator. I wish I had written a paper on it, because I'd be famous now. We'd call it the Sloan return on invested capital. I'm not sure who actually came up with the ratio, but I'm going to take credit for it because I came up with it. So anyway, let's look at return on invested capital. Like return on assets and return on equity, this ratio measures how well a company is investing the capital supplied by investors and by lenders. And remember, what we're trying to do in business is generate a return. That's what the goal of all businesses is, to generate a return. Excuse me. And that return must be higher than the cost of capital. If it's not, then we're destroying value. If the return is higher than the cost of capital, we are creating value, and we will be self-sustaining. All right, so you compare this ROIC to the cost of capital to determine whether a project makes sense, and we also compare our return on invested capital to the return on invested capital earned by other firms to assess the job our management team is doing. So we're going to do trend and peer and also compare our ROIC to the cost of capital. Sorry, I've got a bit of a cough today. So here's the formula. With that long-winded introduction, let me give you the formula. The formula is NOPAT divided by net operating capital. That is the formula for return on invested capital. And so let's now define NOPAT and net operating capital. We've gone over NOPAT before, but let's revisit it. NOPAT is equal to EBIT times 1 minus the average tax rate. So it's a form of cash flow. We take EBIT times 1 minus the average tax rate. The reason we take EBIT instead of pre-tax income is we want to ignore interest expense, and we ignore interest expense to try to put all companies on the same level regardless of how much debt they use to finance their operation. We want to cancel out the financial engineering, the financial impact that a management's decision about using debt has. So we're going to ignore debt and interest expense. Excuse me. Net operating capital is working capital plus net fixed assets. Okay? So NOPAT comes off the income statement, and net operating capital comes off the balance sheet. All right, so here's our first example, very simple example. Let's say a firm has net operating capital of $15 million. Okay, that's how much they have invested in their assets. Remember, working capital is total current assets minus total current liabilities. And when I say net fixed assets, let me just elaborate. I'm talking about all non-current assets. So we're talking about property, plant, and equipment, and we're talking about intangibles like patents and copyrights. And if there's a line item that says other non-current assets, so we're looking at total non-current assets along with working capital. Okay, so the company has NOPAT of $1 million, they have net operating capital of $15 million. ROIC is the $1 million of NOPAT divided by the $15 million in net operating capital, and they have a return of 0.0667 or times 100, which gives a 6.7% return on invested capital. All right. Let's look at another example. We're going to use the financial statements to help us out too. We're going to compute our NOPAT, and we're going to compute our net operating capital in this example. So this is a little more comprehensive example. So let's compute return on invested capital. All right, so we've got Harding Inc., and here's our income statement. Okay, and so we're going down the list, and remember what we're looking for. We're looking for EBIT. Now this is a complete income statement. It's got interest expense, it's got pre-tax income, but we're going to stop here with EBIT. Okay, and here's our tax rate of 35%. So we're going to multiply our 35% times our EBIT of 3,500. Now remember that you compute your taxes to get NOPAT on EBIT, not on pre-tax income. We're ignoring interest expense. So the 35% times the 3,500 is 1,225. So we're going to subtract our taxes from our EBIT, and we get our NOPAT of $2,275. This is our cash flow. This is what the asset, that the investment that we've made, this is the cash flow that is generated, okay, from operations. All right, now let's look at net operating capital. This is the denominator, and we're going to get this off of the balance sheet, and it is working capital plus net fixed assets. Remember, net fixed assets, non-current assets, they're the same thing, they're synonyms. Okay, so here's our balance sheet. So we're going to look for working capital first, and we've got total current assets, and we have, here's our current liability. Okay, so here we go, working capital, current assets minus current liability. So we have 6,000 minus 4,000. 4,000 is 2,000. To that, we're going to add our total. We're going to add our net PP&E. And again, I don't want to confuse you. On this balance sheet, the only non-current asset we have is net PP&E. On many balance sheets, you see other non-current assets and total non-current assets, and that's what we look for, total non-current assets. So the only non-current asset we have on this balance sheet is net PP&E, so this would be total non-current assets. So we're going to add the net PP&E to our $2,000 worth of working capital, and we get net operating capital of $32,000. So we have our numerator and we have our denominator. So let's put them together, and ROIC is equal to NOPAT 2275 divided by net operating capital of $32,000, and we have 7.11%. So there you have it. Net, we have return on invested capital that goes with our other return ratios of return on assets and return on equity, all trying to measure for us how well a company is doing in terms of generating returns. And very important ratios. These ratios determine if we stay in business. These return ratios determine if we attract capital from investors in the form of debt and equity. Is our operation, is our enterprise worthy? Does it merit investment? Do we create value? All right, that's it for now. We'll see you with the next at the next appointed hour. Peace. Shalom.